Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I've actually been following his work for years now. He's put out a bunch of mini documentaries on YouTube. He used to post over at Dave Kranzler's Investment Research Dynamics. He now has a Substack, Best Evidence, and also a YouTube channel also entitled Best Evidence. He's been exposing corruption in both government and at large corporations for years. His career is also a lawyer. John Titus, thank you for joining me.
Thanks for having me.
So, John, I just listened to your interview in the last couple of days that you did with Dave Kranzler, and you were talking about how you saw this banking crisis coming months in advance. So how were you able to predict that a banking crisis was coming months ahead of time?
I didn't. Was it months? I did a video called "Why is the Fed Provoking a Banking Crisis?" around February 22nd. So it was 3 or 4 weeks before the crisis hit. But it was pretty obvious to see it coming because there's two things really. One is with increasing interest rates. That increasing interest rates, it kills the value of assets that are basically income streams. So, for example, from the bank's point of view, your mortgage is an income stream. Every month you pay $1,000, right? But if the interest rates go up, the $1,000 payment stays the same, right? But now, because the interest rates went up, you only need a borrower to take out, say, for things with, like a $100,000 loan. The amount of money they have to borrow is less once interest rates goes up, because the monthly payment, obviously is a lot bigger when interest rates go up. And so when a bank tries to sell that paper sitting on its books, say a mortgage, it's not going to get as much money as it could have gotten when interest rates were way low. That's just the way things work. So that was one thing. It was like, that tells you that there's a potential solvency crisis with the banks, because they all have time-based assets on their books, whether it's mortgage-backed securities or treasuries or what have you. They're all income streams, and they're all hinged on an interest rate. And when interest rates go up, those financial instruments, those debt-based instruments, their value goes down. That is just mathematics 101. That's how things work. But that's really the solvency crisis. What tipped me off that there was a liquidity problem was that banks were borrowing very heavily from the Federal Home Loan Board banks. And whenever that happens, if you look through history and you looked at a graph of borrowing at the Federal Home Loan Board banks, there's 11 of them. It's kind of like a junior varsity Federal Reserve. It's districts. But you can track how much money banks are borrowing from the Federal Home Loan Board through the FDIC. And if you look at a graph of FHLB loans from banks over time, what you'll see is that when banks start borrowing heavily from the FHLB, that's their canary in the coal mine. There's a financial crisis coming right on its heels. So I knew just by looking at, I think it was third quarter and maybe even second quarter reports from the FDIC, the quarterly banking profile, I could see the FHLB loans going up. I'm like, whoa, they're way, way, way up. And whenever that happens, that's big trouble. And sure enough, I mean, it makes sense, right? Because you have, 4,700 banks in the country, and some of the banks, and I didn't see this part of it coming. This part, I'm telling you now, is hindsight is 2020. You had two banks. Signature was really heavy into crypto, and Silicon Valley Bank really heavy into, obviously startup ventures and venture capital. Those banks are kind of one-trick ponies. And if those industries, meaning they service a specific segment of the population, their bank customers at those two banks, there's not a lot of the gamut is not very big with them. They're small. It's a small clique of people. And when that clique of people gets into trouble, they're going to start, moving assets out and transferring deposits out. And that's going to leave the banks in a lurch. And when that happens, when people move their money out of banks and the banks have to sell their assets, now that solvency problem I talked about, where you got to liquidate that mortgage-backed security, or you got to liquidate that treasury, now you're going to take a bath. because you're going to sell it at less than what you bought it at, and you're going to have to write that down in your books. You have to write it as a loss, and then the regulators are going to come knocking, and that's exactly what happened. But that was pretty easy to see, the solvency and the liquidity problems there.
And it looks like this is just the first or second inning of this banking crisis, because the bank that we're seeing now with all the problems is First Republic Bank. And it looks like they have a lot of problems with their mortgages that were given out at much lower interest rates. And now they're going to have those write downs, like you said. And if these banks have a balance sheet problem, unless they're a too big to fail bank like JP Morgan or others, they have to mark to market those losses on their loan book and other assets in the US Treasuries or other assets that they've bought. And then they have to go and try to go to the capital markets and raise equity. But as we've seen with some of these other banks, if they try to raise equity, the equity is not available, and then people start to panic, and it basically becomes a vicious cycle with what you saw with Silicon Valley Bank, how like Peter Thiel, David Sachs, some of the other venture capitalists and insiders were pulling their cash out weeks ahead of time because they had been tipped off that Silicon Valley Bank had problems with their loan book and other investments, and they were going to have to raise equity. So that created like a vicious cycle, basically kind of a bank run, and then the word spread and people started pulling their cash out and moving it to safer things like short-term US Treasuries, money market funds, or to checking accounts or savings accounts at the larger banks.
Well, that's the story, that they were tipped off, that there was a problem. Whether they were tipped off or whether they were instructed to do what they did remains to be seen. We'll see whether a real investigation takes place. I tend to doubt it. But First Republic is not really. Yeah, they borrowed pretty heavily from the Federal Home Loan Board too. But I've looked at their numbers, and here's the thing: they don't really. The tell to me that Silicon Valley Bank, a Signature Bank, what makes them different than First Republic, and I think the big boys see the same thing, is that at Signature and Silicon Valley Bank, if you look at your whales at that bank, meaning people with way over $250,000 in their accounts, boy, the whales, they really came home to roost at those two banks, the ones that failed during the pandemic. Okay, so in other words, at Signature Bank, I'll just give you an example. At Signature Bank, before the pandemic, the average account holder, the average account north of $250,000 was just south of $2 million. Okay, that's a lot of scratch. But after the pandemic, it was the average account over $250,000 is $3 million. That's a huge increase. That's a major red flag that you've got whales in your pond. And if those whales leave, you are big time horse, you know what. And the same thing at Silicon Valley before the pandemic, the average whale account, meaning north of 250, was just south of 3 million. After the pandemic, it's over 4 million. I mean, again, you have huge accounts. If you listen to testimony of the failure at the Senate Banking Committee after the failure of Silicon Valley Bank, they said they had 10 accounts there with $13 billion in those accounts. You tell me, who has $1.3 billion in an account? I'll tell you, the last person I remember with that much money in a checking account or a savings account, his name was Bernie Madoff. He had $5.6 billion at JP Morgan Chase. People don't keep that much money in those accounts because they don't pay any money. People keeping that much money in those accounts, they're up to no good. And that's what they were doing. They were up to no good at Signature, and they were up to no good at Silicon Valley. First Republic, you're looking at, a move from 1.5 million to 1.6, 1.7 million in those accounts. Yeah, they don't have the same, it's just not putting off the same aroma that those other two banks were. It doesn't to me look to me like a one-trick pony. And but like they do borrow from the FHLB, but it's not. They were always borrowing from the FHLB. 3 years ago they were borrowing from the FHLB, and so in fact 3 years ago they were actually, as a percentage of equity, First Republic was borrowing more from the Federal Home Loan Board than it was after the pandemic. So yeah, First Republic. I'm not saying First Republic's a great bank, but I would, and the powers that be have stepped in and they've kind of saved it. because I think they sense it is an okay bank. I think the bank to really keep your eye on, I would keep my eye on Schwab.
But isn't Schwab just a stock market brokerage? Are they actually doing other
No,
banking
it's
too?
not. It's the seventh biggest bank in the U.S. And you can look it up. It's got an FDIC certification number, 57450. I mean, it is a bona fide bank. It is a brokerage too, but it's definitely got banking because they sweep brokerage account deposits. They sweep them into bank accounts. Schwab, in other words, when Schwab Bank lends you money, it's not getting that money from a vault. It's clicking that money into existence on a spreadsheet, just like real banks do, because Schwab is a real bank. And the thing that the red flag with Schwab is, 3 years ago, even a quarter or two ago, they didn't have any loans from the FHLB, and all of a sudden, I think it was the third quarter of 2022, they went from zero to $10 billion in loans from the FHLB. To me, that's a huge red flag. And that it's funny that in the wake of the crisis here, the two bank crisis so far, nobody's really talked about the FHLB, which to me is like, this is a layup. Just go look at the graphs and you can see FHLB lending in the '08 crisis. It predated even the repo borrowing, the panic borrowing in the repo market, which is for sure a canary in the coal mine. So FHLB lending is a real thing, and it's going on at Schwab. It's going on at First Republic too, but like I say, First Republic has been a long time customer of FHLB. There's no sign of panic in the water at First Republic the way there is at Schwab.
And this is residential real estate for the FHLB that you're talking about. This is not the commercial U.S. commercial real estate, which I think is probably the larger short-term crisis that's coming over the next 3, 6, 9, 12 months.
I think that's probably right. But I'm looking at the FHLB from the point of view of I'm a bank. Maybe I'm in trouble and I need some money. So I'm going to go borrow it. And banks tend to sort of they want to get the lowest rate like everybody else, and they want to avoid the Fed discount window, because the Fed discount window,
it's public. Everyone's monitoring it. Yeah,
everybody's watching it. Everybody's watching it, and nobody's watching the FHLB. So it's an easy way to kind of go get. The way the FHLB works, by the way, is it's a government sponsored enterprise that nobody talks about, and because of its implicit government backing, it's able to go out and say, hey, we're going to sell IOUs at, 1%, and they get buyers of them or whatever. They sell them at a low rate, and they turn around and they lend that money out at a higher rate. And that's how they operate. So it's kind of like the Fed, but not really. But it's a low cost source of major funding for banks when banks are in trouble. And that's why I'm looking at the FHLB. But you're exactly right. It is set up for residential real estate. That's what they do. But over the years and over the decades, Jason, I mean, like everything else, it starts out with mission A, and then the next thing you know, it's like, wow, it's suddenly the favorite lender of the too big to fail banks. You know what I mean? It gets corrupted. It gets converted into the tool and the instrumentality of the major players. And that's what's happened with the FHLB. But nominally, you're right. It is in the residential real estate market. And I also agree. I think the commercial market, I mean, who's going to work in downtown? The big box model of going to work at the big law firm or whatever downtown, that's a sick model now. It's not working out too well. There are not many people doing that anymore. So that market is taking a huge hit. Yeah.
It's not just the higher interest rates that are causing the commercial real estate bubble to pop. I mean, it's the occupancy rates. Landlord has higher interest payments on their mortgage debt that they used to buy the commercial real estate space, but then they can't pass on the higher rents because these companies, whether it's a law firm, a large corporation, they're just saying, well, we can have more of our employees work from home. We could buy cheaper office space. We don't need the more expensive office space, the square footage downtown that's more expensive.
And we especially don't need it. I mean, I cut my teeth and work still got an office in Chicago. These towns are not, they're, Chicago and San Francisco really aren't, you don't want to be walking around in those towns, really. They're dangerous. Crime has become a real problem in those towns. And that's yet another factor that's just pounded commercial real estate into the sand now. So any bank that's really wrapped up in commercial real estate, you keep your eye on it.
That's a overwhelming majority of the regional banks. So I interviewed someone who had a large ownership share of a regional bank, and he said 60 to 70% of their loan book industry wide for regional banks is in commercial real estate and small business loans.
Yeah, that may be true, but I'm wary of the regional crisis sales pitch. It's regional, yeah, but there's a lot of regions like, Mayberry, North Carolina, where it's like, yeah, they might have commercial real estate, but downtown Mayberry is safe and it's a good bet. And, the lending was local and they tend to know what they're doing. They're not the big boxers in the big towns like Chicago and San Francisco. So look at the crisis so far. So far, the crisis is Signature Bank and Silicon Valley Bank, okay? Signature is the 30th largest bank in the country. Silicon Valley was 16. There's 4,630 banks in the U.S. This is not a regional banking crisis. What is going on is there's a crisis so far, and it's too big to fail went from 4 to 6 banks, and now it's expanding to, it looks like 30 banks. I think that's what the Fed is up to. They want to expand too big to fail. They're calling it a regional crisis to sort of, in my opinion, draw attention away from the fact that it's really mission creep and too big to fail is getting bigger. It's just they're expanding the web to include more and more assets, a greater percentage of total assets in the country. I mean, there's $17 trillion on deposit right now in the U.S. It's actually 17.25. I'm looking at the graph right now. And, the top 30, that's far and away the overwhelming majority of that 17.25. I'd bet you it's probably around 12 or 13 of that 17 is the top 30 banks. So think about that. That's a huge concentration. If you start to see, you remember the game they played in the '08 crisis, what I would call the nesting cadavers? That WAMU goes down, no problem. Just stuff it inside of Wells Fargo. Oh, Merrill Lynch is a problem? No problem. Just stuff it inside the cadaver known as Bank of America. They played that game a lot in '08. And I'm starting to see that same thing now. Like these banks, those assets don't go up in flames. Somebody takes possession of those assets, right?
Well, the Fed was subsidizing all those mergers and acquisitions. Actually, a lot of the bankers, whether it was Bank of America or Jamie Dimon at JP Morgan, they really didn't want to buy Bear Stearns or this other stuff because there were all these hidden liabilities with derivatives and other problems. But the Fed basically said, we're going to backstop everything with loss guarantees.
Yeah, the Bear Stearns was the bailout of Jamie Dimon. That was a sweetheart deal. JP Morgan walked away from the so-called collapse of Bear Stearns, which is really a hit. JP Morgan walked out of that deal with $55 billion to the plus side, $30 billion on the Bear Stearns side, and 25 on the JP Morgan side. JP Morgan got a sweetheart deal out of that collapse. They were the big winner out of that. There's a guy who's an option trader in Chicago named John O'Legs, Olagues, who was an option trader, like I said, and he wrote a big piece saying this is a total hit. Bear Stearns was completely thrown in front of the train, and he lays it all out in a very forensic manner on basically proving that it was a mob hit at Bear Stearns and a takeover of Bear Stearns by JP Morgan, and that was the last thing he ever published.
But weren't their balance sheet was leveraged 60 to 1, so their asset book only had to drop 1.5% and they were insolvent though. I mean, they had lots of bad stuff on their books with derivatives and bad loans. Yeah. They were stuck holding a bunch of subprime mortgage-backed securities and bad paper. I mean, they just got caught when the game musical chairs ended. They were the first one out because of the leverage on their balance sheet. And then Lehman Brothers.
Everybody was leveraged though.
Well, 60 to 1 is different though than some of the other banks. I think Citigroup actually was close to 100 to 1 at the crisis, which is why the Fed had to.
Exactly. Citigroup was the worst of the lot. Citigroup lost $30 billion that year. Merrill Lynch lost $30 billion that year. These banks were all garbage. They were trash. And Bear Stearns was bad, but they had a lot of company. And Lehman was garbage. Lehman was a piece of, you know what?
But everyone
There was
hated
a lot of garbage floating around at that time. But Bear
everyone
Stearns,
hated
huh?
I was just going to say everyone hated Dick Fold, though. So all the people at the other bank CEOs and the people at the Federal Reserve Bank and in the U.S. Treasury, you had Hank Paulson back then, who was head Treasury Secretary, and he was former Goldman Sachs CEO, and he hated Dick Fold. So, I mean, they weren't going to go out of their way to bail out Lehman.
Yeah, there's a lot of stories floating around about Dick Fold. There was also a lot of stories about Jimmy Kane at Bear Stearns. And, if you want to laugh, if you want to chuckle, look up what Jimmy Kane said about Tim Geithner. It's one of the funniest things I ever read during that crisis. And I'm telling you, there wasn't a lot to laugh about during the crisis, but that was what Kane said about Tim Geithner cracked me up. Anyway, but you're right. They did hate Dick Fold. He was a marked man after one dinner apparently he had with Hank Paulson, where he said some things I imagine he might regret.
I think he used to work at Goldman Sachs a long time ago, but yeah, he had a lot of enemies on Wall Street, so they weren't going to do him any favors.
No, right.
I want to get your thoughts, though. So you think the Fed's going to do more bailouts? Because I interviewed Danielle DiMartino Booth a couple weeks ago, and she's adamant that the Fed's going to continue to raise interest rates, that they're going to let their official balance sheet fall. They're not going to bail out regional banks. They're not going to save commercial real estate. They're not going to save any of the other banks this time. Do you think that that's the case, or do you think the Fed's going to have to step in and do similar tactics? They're going to do similar tactics to what 2008.
Here's what I think. They're definitely not going to bail out regional banks. If we understand regional banks, meaning you're not in the top 30, you want to call that a regional bank? I agree. The Fed's not going to bail them out. I kind of doubt a lot of those banks, vast majority of those banks are fine. They don't need to be bailed out. The problems are always the big banks. That's where the criminals are. Here's the thing, and I think there's no way out of this. This is like, you can't avoid this reality. There's no escaping this. And it's this. If you look at the budget right now, and I've been, I'm 57. I've been hearing, the boy who cried wolf about the budget deficit since I was a kid. I mean, for over 40 years, I've heard, deficit and the debt's a problem. But now I'm telling you, it's a huge problem because we've entered an era where the wolf is here, and the wolf is this: if you add the interest payment on the debt to what I'll call your non-negotiable obligations, Social Security, Medicare, and Medicaid, those three, you're now at a point where those obligations of the federal government are north of your tax revenue. And that's ballgame, because what it means is you're basically borrowing money to make your interest payment. And technically you'd say, well, that's not an interest payment because those three things aren't interest payment. Yeah, okay, there may not be a contract, but there's a social contract. And the social contract is this: when you're younger and you're healthier and you're making money, you pay into the system. When you're older, you get your money back out of the system. That's the deal. That's why I say those things are really non-negotiable. But those four things, interest plus Social Security, Medicare, Medicaid, they're now north of tax revenue. And the U.S. federal government is borrowing money to make what I'll call the interest payment. And in fact, the Treasury, the last two annual reports, actually the last three consecutive annual reports have said the U.S. fiscal path is unsustainable, meaning we're going to have to really implement austerity and start doing things like really cutting welfare payments, Social Security payments, Medicare payments, that sort of stuff. They never, of course, even consider, defaulting on the interest payment. But you reached a point where you can't get out of that. There's no way out of that. You can't grow your way out of that. The only way out of that, from the borrower's point of view, from the sovereign's point of view, historically, is they try to inflate their way out. So this notion that the Fed is going to cut on the long term is laughable. I just spit on that. It's ridiculous. They might head fake you in the short term and get away with it in the short term, but long term, that's a money printing operation. No two ways about that.
Yeah, I agree. Yeah, I agree, especially because you have the foreigners. So China, Germany, Japan, which used to buy lots of U.S. treasuries, they recycle their foreign exchange reserves, their trade surpluses back into U.S. treasuries. They are no longer net buyers.
Right. So who's the buyer? Who's going to buy now? The Fed. right?
Or they changed the laws similar to post World War II, and they stuff the larger banks, the too big to fail banks, with a higher percentage of U.S. Treasuries, and the banks just hold the Treasuries, use that as collateral, even though it's being inflated away.
Yeah, but I think the banks that game's only gonna work so long is stuffing them into the banks because the banks are saturated at some point. In fact, I think I would expect the banks to get bigger. I think you're going to start to see some weird things like, Goldman Sachs selling off its banking business to JP Morgan. What you're going to see you're going to see too big to fail to get too bigger to fail as the government, as the Fed tries to cope with the inflation problem I'm talking, or the debt problem I'm talking about, the runaway interest problem. The Fed can't, that's another thing. The Fed can't keep interest rates up. The interest payment right now is $800 billion or whatever it is. You're gonna raise rates more on top of teeth of a $30 trillion debt. You're gonna increase the interest rate. I feel like Nick in the movie The Deer Hunter. You remember that?
No.
Remember Christopher Walken's? He's looking at these guys they're caught by the VC. They're going to get blown away. They're like playing a game of Russian roulette. And De Niro looks at what Christopher Walken goes, "I got a way to get out of this. We're going to kill each other. Let's put more bullets in the chamber." And Walken looks at De Niro and he's like, "What? More bullets? Like, are you out of your mind? We're pointing a gun at our head." That's me looking at the Fed. Like, you're going to increase the interest rate with the debt as high as it is? No, you're not.
Well,
you're not going to do that.
So if the Federal Reserve Bank actually had to adhere to generally accepted accounting principles, so which is what a private sector business would, other than a large too big to fail bank like JP Morgan, the Federal Reserve Bank would be deeply cash flow negative, and they'd basically be insolvent and have a balance sheet problem because these higher rates, not only is the U.S. federal government paying higher interest payments on the debt, the Federal Reserve Bank also has to pay higher rates to the banks that have parked trillions of dollars in cash at reverse repo. And then there's trillions of dollars in cash from the old QE programs at the interest on excess reserves area. So the Fed is actually, I think they're deeply cash flow. And the former New York Fed trader, Joseph Wang, actually talked about this months ago and put out charts. I mean, the Fed's over 60 billion cash flow negative now with the higher interest rates.
That's a great point. That had slipped my mind. You're exactly right about that. The Fed is, in other words, the Fed is supposed to make a profit and turn over the profit to the Treasury. What's it turning over now? It's turning over an IOU saying, well, we'll get it later. Like, are you really? And you're going to increase interest? You're going to make that problem worse? How long do you think this is going to go on before Congress just erupts over it?
Well, this is why Ron Paul wanted a Fed audits routinely, and then he left Congress after he got the one-time partial Fed audit in 2011. He just, I've interviewed him 3 or 4 times about this over the years, and he basically just said he gave up after the one-time partial Fed audit because he said that the Fed's team of lawyers wasn't going to allow it again. I mean, I don't know, the Fed's balance sheet, their official balance sheet is a disaster. It's saying it's going down, but what's off balance sheet and special purpose vehicles? Jim Bianco Research wrote a Bloomberg op-ed piece back in 2020 saying the Fed now has the U.S. Treasury approved it, legalized off-balance sheet special purpose vehicles like Enron. They could stick whatever they want there.
Yeah, they did that. They did that in 2008, So that's a trick that they'll probably pull out again. The odd thing is it's hard. The Journal actually did a series of articles about it. Exactly what you're talking about is like you put something in a special purpose vehicle and basically shoot it in the head and make it go away. And, nobody's the wiser. The Journal did a series of reports about that back in 2008. And then I can't find them now, but you're right about Ron Paul. Ron Paul retired, and the other big player in the Fed audit was a journalist from Bloomberg named Mark Pittman. Pittman had a heart attack at age 51 and died right after they win. Let's see. So the players back then who affected and caused that audit to take place, they're pretty much gone.
And I don't think anyone in Congress on either political party, I mean, you have a couple people like Dr. Thomas Massie and Rand Paul and a few others, but the majority of people in both political parties will not allow Fed audit. And then the Fed has an army of lawyers who are super high paid. And obviously they have you have the group of lobbyists with the derivatives lawyers here in the DC metro area and the K Street guys at the lobbying firms. They don't want the average American person to look into this stuff, and they don't want Fed audits.
Yeah, for sure. I mean, I read the briefing back with the Bloomberg and Fox lawsuits, the FOIA lawsuits back in 08 or 09. And the district court judge from the Southern District of New York was Loretta Preska. She was chief judge there. But as good as the lawyering was, I mean, you're right, they do hire the high dollar lawyers, the Fed does. They got beat. Bloomberg beat them on the briefs. And
wow.
Yeah, Bloomberg beat them, and Preska ruled in favor of Bloomberg, and the Fed took it up on appeal to the Second Circuit. And I was like, okay, well, now they're going to reverse it. And it didn't. This Second Circuit, it was airtight. Preska's work was airtight, and it got affirmed on appeal. They tried to go to the Supreme Court. The Supreme Court didn't want to hear it. And thus the audit took place. They can be beat. These guys can be beat. Their position's not that good. They got beaten on summary judgment, which is like, we don't even need to get to a jury on this. We should win on the papers. And Bloomberg won on the papers.
And they got over 30.
Don't think they've got an army of Supermen. They don't.
Well, Bloomberg got over 30,000 documents released from a Freedom of Information Act in that FOIA request in that lawsuit. But normally with the FOIA request for U.S. federal government agencies, I mean, the stuff that's returned, it's Sharpied on both sides of the paper. So you get almost nothing normally in FOIA requests.
I FOIA'd the Fed, and they coughed up. They gave me what I was looking for. Now here's the thing. I can't. Did they give me everything that I asked for? Did they turn over every responsive document to my FOIA request? I can't tell you. I have no indication from what they gave me one way or the other. But they did cough up, 24 documents or so. But I was looking for, there was no way to duck what I was asking for, because what I was asking for, there was in the Fed transcripts, which come out 5 years after the FOMC meetings. Some people had said, hey, we see in staff memos that if we do X, then Y happens. So I wrote to the Fed and said, hey, I have a FOIA request. Those staff memos this guy's talking about, I want to see those staff memos. And the Fed coughed them up. But like I say, I don't know whether they gave everything. If you go through the motions, it's worth doing, because you'll learn a lot, and odds are good you'll get what you're asking for. Now, if you go in and you don't know what you're doing and you ask for the whole wide world, you're not going to get anywhere. But if you're targeted and specific and like an assassin, and you're trying to pick people off like from a rooftop, you'll get what you're after for sure.
Is that what's happened with the documents that we've gotten about the bailouts during the 2019 Repo Madness crisis? Because I know Wall Street on Parade is going through these things thanks to Dodd-Frank, and we do get some of the information out about the size of the bailouts during the repo crisis.
I don't know. I've written to Pam Martins a couple of times. That's her website, but I don't know what documents she's looking at. I don't know what she's seen. I haven't kept up with that. What's the headline on? Here's what I want to know. Why was there a repo crisis in September of 2019? What happened to cause that?
Oh, I'll tell you, I was getting emails and messages from portfolio managers, from bank portfolio managers in other countries, investment bank ones, anonymously. Some were anonymous and some weren't. It was the risk parity trade that Ray Dalio made popular on Wall Street and with hedge funds. So you had portfolio managers at investment banks, and that was during the last Fed rate hiking cycle. So you had all these,
right.
And so you had all these large banks, their bond fund portfolio managers there, and hedge funds, and they had added all this leverage. They had borrowed in repo to leverage up their trades further, because back then the interest rates were low. So they were trying to get capital gains increases on the nominal value, on the principal value of the bond, rather than buying a bond, just for the yield. They were trying to buy a bond for capital appreciation when the Fed was lowering rates. Well, when the Fed was raising interest rates, that blew up the entire risk parity trade. I mean, from what I heard, basically almost all the large players that had done the leverage risk parity trade, they all blew up in 2019. We're talking like...
So what you're saying, if I understand you correctly, that was a lot of information, is that a bunch of banks made the same bet at the same time the wrong way.
And hedge funds. I'm hearing like Citadel, Ken Griffin. I'm hearing like there was like Ray Dalio, Bridgewater. I'm hearing like super big players, hedge funds that have hundreds of billions or trillions in assets under management, bond fund portfolio managers at the investment banks, I'm hearing they all blew up on risk
But if
parity.
everybody at the bar is betting on the Broncos, okay, and it's just an internal pool, it's pari-mutuel within that bar, and the Broncos lose, and nobody's going to get paid, right? And nobody's going to be able to buy a drink. Everybody's out of money at the same time, right? That's what happened. That's what you're saying.
Well, they couldn't pay back. They couldn't pay back the money at the repo market, and the money market funds had loaned lots of their funds into repo. So that's why you had the Fed step in, because the Fed said, okay, the repo markets are broken. The money market funds had loaned all this into repo for extra returns, for extra income. And now the money market funds can't get paid back. So you had pension funds, the money market funds. It was just a disaster in 2019.
Huh. Yeah, I didn't know that FOIA documents had been coughed up on that. That's news to me.
It was the risk parity trade, because the risk parity trade was set up to juice returns on bonds when interest rates were low. But the Fed rate hiking cycle in 2017 and 18, and then it ended in 2019, that blew up the risk parity trade. So like these rate hikings, the system is just too leveraged at this point, because of fractional reserve banking, the derivatives market, you have these hedge funds and the portfolio managers at banks. They just put on all these leverage trades, and a lot of them expect bailouts.
Indeed, they do. Indeed, they do. Imagine that. They're counting on those bailouts, and if they don't get them, it's like a drug addict. If you've seen a drug addict doesn't get his heroin, it's not good.
Well, look at
start having a seizure.
Well, part of the problem is that if you're a JP Morgan and you're manipulating gold and silver, or you're manipulating LIBOR, or you're manipulating foreign currency exchange markets, you just pay a tiny fine. No one's going to prison for any type of egregious market manipulation or causing a bank to fail and needing a bailout.
Yeah, right. So the Fed, leading up to September 2019, the Fed had been raising rates for a while, right?
Yes. And that was, you had all these risk parity players that were all leveraged bond fund traders, but that were betting, basically all their leverage was betting on lower rates, because they had set up their trades for the value of the bonds to increase while interest rates were being lowered. So so
the system's addicted to the low cost money, right? They're counting on that low cost money.
Well, they had also bet on lower rates on financial repression. So when the Fed was raising interest rates, all their trades, they didn't have hedges in place, and then they didn't have cash reserves. They had just too much leverage betting on lower rates. This is some of these same problems happened with Credit Suisse. I mean, I was told over 12 months ago that Credit Suisse was a mess. They had over 30 billion in loans out to Archegos, and they were considered a fairly small family office, which is kind of a hedge fund. But I was told by hedge fund manager contacts, they were telling me this when Archegos was happening, that Credit Suisse had tens of billions in loans out to a bunch of different hedge funds and family offices. And then they had bad derivatives trades and other bad crypto and venture capital and private equity investments on top of this. So it was a ticking time bomb 12 to 18 months ago.
So Credit Suisse had lent out $30 billion.
They only wrote off $5 billion at the time. I think back when Archegos news hit, within a couple months of that, they wrote off about $5 billion, which was their entire, I think, net profits for 2021. And the mainstream financial media just swept it under the rug. But I mean, like, I was told that they had lots of loans out in similar size to many different size hedge funds and family offices of Archegos amount. And the mainstream financial media just stopped covering it. They covered Archegos, I think, for a couple weeks, and that was it.
Yeah. Well, that's another thing, with these banks is, loans, Signature Bank, loans is a big part of their business. And if they start going bad, that's a bad situation. Now, Silicon Valley Bank wasn't so bad. It was, loans weren't such a big part of its business, but Signature Bank, it was over 2/3 of their business was loans, right? 2/3 of their assets was loans. The balance being largely securities. But you're right. I mean, if a bank has got all these loans out there, I mean, $30 billion, that's a big amount of loans for a bank, I must say.
And that was one loan to a family office.
That's to one party. That's horrible bank management. I can't believe that. Anyway.
None of these things surprise me anymore. The stuff that the banks do in the derivatives market, it's absolutely crazy. I mean, I don't know if you saw this recently, but actually as part of the agreement, someone who's an anonymous financial professional, he uses a pen name, and he went through the agreement that UBS got from the Swiss government for agreeing to buy Credit Suisse, and they actually got in writing loss guarantees on all the derivatives that Credit Suisse has, all their interest rate derivatives that are going bad, that are illiquid and incredibly difficult to value. So the Swiss government and the Swiss central bank, the Swiss National Bank, are guaranteeing all the losses for UBS to buy Credit Suisse.
Wow. Yeah, another sweetheart deal. Kind of like Jamie Dimon got, JP Morgan got with Bear Stearns.
Well, my educated guess is that like the European Central Bank, the Swiss National Bank, and the Federal Reserve Bank are involved in that too, because they kind of realize if you have much in interest rate derivatives, and the counterparty has to be a bank either like Deutsche Bank or another American bank, and so then the counterparty would have a default, and then the counterparty bank would be in trouble too.
Yeah, right. It takes two to tango. That's exactly right. The swaps, though, the swaps right now thus far are kind of quiet, right? They haven't really reared their head so far in this crisis.
Well, I think it was Credit Suisse. And then a week later, Deutsche Bank, and then there was a 60 billion emergency draw from the Fed's permanent repo facility for foreign central banks, and no one knows the exact central bank that borrowed that 60 billion. I know Kyle Bass has tweeted out that he thinks it was China. But
well, could be, but I'm saying if you look at the Fed's balance sheet just on swap, if you just look at central bank liquidity swaps, just a classic, bread and butter swap, not even a blip.
Yeah, I don't trust the guy Albert, Live Lemon on Twitter. He drinks with a lot of the people at the DC Fed, and he said 9 months ago, he said the Fed has over 3 trillion in currency swap lines outstanding. They're not even counting on the balance sheet. So he said one of the other central banks got in, one of their large banks has been in trouble for over 9 months, almost 12 months now, probably Credit Suisse or Deutsche Bank. And he said that the Fed's not even counting a 3 trillion swap line that's not even being paid back and not counting it on the balance sheet. He says it's counted as either a credit or a short-term loan in their internal accounting, not publicly listed. That's what he's adamant about this. So
I hear stuff like that. That's scary, because normally, I watch these banks a lot, and I've been watching them for a while, and I've read a lot. And they try to, one of the reasons I go to the Fed graphs a lot is because it's the one advantage of a ledger-based system is what you just said. For every asset, there's a liability, right? I mean, your debt is someone else's asset. And so there's a kind of an inherent pressure for the data reported by the Fed to be accurate, because they want to keep score. That's one thing about bankers, is if they're good at one thing, it's keeping score. Who owes who? So for you to say, hey, they're not keeping score here, or there's a side book, there's a side hustle going on, it's not booked, that's scary.
Well, if you're the world reserve currency, do you really need Japanese yen or British pounds or euros? You don't need that stuff. You have the dollar, which is the supreme currency for all these transactions, for cross-border trade settlement and derivatives contracts and buying commodities.
That's the point. Mm-hmm. They need it, and they report it because they keep score. You see what I mean?
Well, Ron Paul actually got to see the real bailout documents in 2008 with the audit, and what he said is that they just pulled them. They gave the bailout loans, and then they just pulled it out. He said the loans were essentially just waived, and that was like the partial bailout he saw from the GAO. He said was at least 16 trillion back in 2008, 2009. But with the Bloomberg Freedom of Information,
the problem with a lot of reporting in 08 is that you have to look at the number like, well, what's going into this number? And one thing that people commonly do, and I don't know whether this is going on here or not, but if somebody goes to the repo window and borrows, $100 a night, they sell their house at $100,000 and they buy it back. They borrow, like $100,000 a night or whatever, and they do that for 7 nights. That to me, that's not a $700,000 loan. That's a $100,000 loan nightly for 7 days. So a lot of times people would try to jimmy up their figure and get, clickbaity sort of headlines by pulling that trick where it's like, well, it's really a $10 loan times 100 days to get you the $1,000 figure.
Well, What
I
the
always
Fed
check
did
that.
in 2019 with the repo crisis is they actually did what you said. So it was just shorter amounts of loans that were overnight at first, but then the duration of the loan just kept being extended because the banks couldn't pay it back. And then eventually the Fed just increased their balance sheet by about $1 trillion officially in about 2 or 3 months. And then people stopped talking about it as much. But the documents we found out about the repo crisis are way larger than that, than the trillion that was added to the Fed's official balance sheet during the repo crisis.
Well, the repo, they would tell you. I mean, if you look at the figures in the repo, the Fed graphs, they go to about they're not even $1 trillion. They maybe 400 billion, something like that. It's not as big as you think. But you're right. It did extend. That repo extended into the pandemic and got bigger in the pandemic, and then it went away because it just got swamped out by other programs, right? Just the large scale asset purchases they weren't done repo, they were done just large scale asset purchases. There's no repurchase about it. So that was sort of to me, the pandemic QE, which started in March of 2020, that to me looked like a total continuation of the repo problem that started 6 months ago in September. Do you follow me?
Yeah, I agree. I think there was a banking system crisis that started in 2019, 6 to 8 months before the pandemic.
I think that's exactly right. And I think that pandemic just kind of, whatever happened, man, was it a convenient cover story, right?
Bailouts for big pharma too. I mean, look at all the crazy legal guarantees that big pharma got, all those big fat government contracts here in the United States with no legal liabilities for causing people.
Yeah, it's really too bad. The way to me, the problem with the bailouts, it isn't so much the money and the brand. I mean, yeah, that's a problem. To me, it's you're just killing the rule of law. You're playing favorites out in the open. I mean, here's a bailout. You have a set of rules. Everybody knows what they are. You get an outcome that the powers that be don't like because one of their crony buddies get hurt. And what do? They change the rules so that the buddy doesn't get hurt. He gets help. That's a bailout.
Yeah,
whether there's money changed in or whatever, but the point is that you are stepping in and saying, you know what, forget the law. I'm gonna supersede the law and I'm gonna implement my own version of what I think ought to be the right outcome. That's a bailout.
But John, historically, this happens at the end of empire. So you can go back through all the major empires throughout history: China, Mongolian Empire, Roman Empire, British Empire, and this level of corruption, currency debasement, taxes, rules, regulations, red tape, picking and choosing winners and losers with bailouts or unbidden government contracts and bribes. I mean, this stuff just became pervasive throughout the system. Now, normally, also it happens with smaller governments too, banana republics. So where like the political party that loses election gets the people either get kidnapped or get financially destroyed or killed.
Yeah. Once you go to the bailout door, I knew that. I knew that in 2008. I was like, you can't. It's a drug. Once you're on the drug, you're not getting off it. I mean, it's just not. It's not going to happen. It's not realistic. You can't go through. You can't stop it.
Well, the problem is the size of the bank.
We are. We have to cope with it.
The problem is the size of the banking system. It's fractional reserve banking. It's the size of the derivatives market. It's too big.
It's the size of the banks. If you got a bank, this is what happened in 2008. You have a bank. Take your pick. JP Morgan Chase, Bank of America, Wells Fargo, or Citigroup. Any one of those banks had 10% of the retail money supply on its books. Any one of those banks could go to the government, which is what they did, put a gun to the government's head and say, give us the money or we'll kill you. And that's what they did. That's exactly what they did. And it's the banks that are too big. They should not have. Back in the Great Depression, the money supply contracted by 33%. Yeah, but it took 4 years and it was 9,000 banks. Now you're at a situation 10 years ago, 15 years ago, where you get a 40% contraction if only not 4,000, 4 of your banks go down, your money supply contracts. That's real power. It was up to Congress after that. If you want to go ahead and bail them out and say, that would have been the end of the world, fine. But, man up and then break those banks up and cut them down to size. And nobody did that. And now we're dealing with it. And now the consequence is you've got a gangster system. You're run by criminals, and that's where we are. We're not getting out of this. We're not voting our way out of this. That's
Oh
what
yeah.
people need to understand. You ain't voting your way out of this. The criminals just took over. The criminals, they're not going to take over and then turn around and go, hey, you know what? Why don't you raise your hand and let's see if everybody agrees that we should just give back our power. Really? Yeah. But what turnip truck did you fall off of to come up with that one? Because that ain't real.
Yeah, the government's also too big and too corrupt, but the banks like grew in proportion, unfortunately, to the size of the derivatives market because they make enormous profits from that. The banks, my view of the banks, John, the large too big to fail banks, is they're basically hedge funds. So they don't even really need a lot of depositor funds. They get unlimited reserves and bailout funds from the Fed since 2008, and they put on these leveraged hedge fund trades. And so the majority of their profits are not even from normal banking. They're from all
Right.
these stock market trading, bond trades, currency trades, manipulating gold and silver and other derivatives. So they're basically like either they're committing fraud and paying a tiny fine, or they're doing hedge fund trades. And then when those hedge fund trades blow up, they get bailouts because they're just too big. The derivatives market's way too big. It should have never gotten to this size.
Yeah. Yeah. Well, it's smaller today than it was in '08, at least according to official figures, but it's way too big either way, for sure.
Is there anything you're researching right now that you're planning a future video for?
Yeah, I'm doing a video to tell people how to check if your bank's in trouble.
Great. Well, if
Yeah.
my
That'll be my next video. I've just moved and I'm just setting up a new studio. So it's taking me some time, but it's going to be really good, and I'll start hammering out these videos again here pretty soon.
And for our listeners who are not familiar, you only have a few videos on your YouTube channel, but each of them has lots of views.
Yeah, I do. I've only got a little bit over 30 videos, but they tend to they're tight and they cover evidence. You know, I don't say stuff unless I can document it. So I call the channel Best Evidence. It's like, listen, you know, I've given you the best evidence that's available. You know, and it's not me saying this. You know, I'm using the Fed documents, or I'm using congressional testimony, or I'm using, you know, a quote of Jamie Dimon in front of a microphone. You don't have to believe me. Listen to what they say. It's sort of the thrust of my channel, but it takes time. But I think it's meticulous. What I'm really doing is laying a record for when all this implodes, and it, you know, people are wondering, hey, you know, why do we live in shambles? What happened? You know, 10 years ago we had buildings and houses. Now we live in dust and we eat mud pies. Maybe they're, you know, they find my record of what happened and they'll say, oh, that's where we went wrong. That's what I'm doing.
So if you were to make
the decline
an
and fall of the American empire.
yeah, unfortunately, there's just too much waste, fraud, corruption, and abuse at this point.
You said a mouthful there.
Well, I've lived right outside of Washington, D.C. for over 20 years. So, and I've had off the record conversations with bank lobbyists, and I met the trade association lawyers for the derivatives guys at crypto conferences. And these guys are just, they're either lying or they're totally ignorant of what happens with the banks and how when the Fed raises interest rates, the banks always get in trouble with their derivatives or their loan book blows up. They make it like these derivatives are not a big deal. They're all netted out. But then here we are every couple of years, every time the Fed raises interest rates, something blows up and banks go bankrupt or a hedge fund goes bankrupt and then bailouts are given out.
Yeah. Yeah, I think we'll probably see more of the same. I think you're right about that.
I think commercial real estate's probably the next one. I know like lots of banks, not just the regional banks, the large banks have enormous exposure to commercial real estate. So we'll see what happens. It's tough to predict which banks will have the most trouble first.
Yeah, it is. It is very, very difficult.
John, I just want to thank you so much for your time today. I'm going to put links to your YouTube channel and also your Substack in the information and description section below the video. My listeners want to check out your work. How do they do so?
Just type in John Titus at YouTube, BitChute, Odyssey, or Rumble, and Best Evidence. You'll find me. I'm not hard to find. Either John Titus, Titus, or Best Evidence. You'll find me.